They told you it was a relic. They told you it was a pet rock. They told you that the banks had infinite paper to suppress the price forever, and that the real price of silver didn't matter, because the derivatives market controlled the world. For 45 years, they were right. Until this week. Take a look at the chart on your screen. That vertical line isn't just a price movement. That is the sound of a dam breaking. That is the sound of the London bullion market running out of metal. We just witnessed a historic gap up, a violent repricing that took silver from $61.94 to $69 an ounce in a matter of hours. This is the moment every stacker, every contrarian, and every believer in sound money has been waiting for. The squeeze isn't coming. The squeeze is here. And unlike 1980, this time, there is no one single billionaire to blame. This time, the call is coming from inside the industrial complex of the global economy. You need to understand the magnitude of what just happened in the dark pools of the London market. We aren't seeing a normal trading rally. We are seeing a liquidity crisis. Right now, the lease rates for silver, the cost to borrow physical metal in London, have spiked to over 30% annualized. In a healthy market, that number should be near zero. When it hits 30%, it means the bullion banks are panicking. It means there is no float. It means that companies like Samsung, Tesla, and the solar giants are scrambling to get their hands on physical bars, because their assembly lines are at risk of shutting down. For years, the psychological warfare against silver investors has been relentless. You were mocked for buying coins. You were laughed at for paying premiums. They wanted you to capitulate. They wanted you to sell your stack and buy tech stocks or bonds. But the psychology has flipped overnight. The gap up we just saw has shattered the illusion of control. The shorts, the entities betting against the price, are now trapped in a room with the doors welded shut. They are facing a melt-up scenario where the price doesn't just drift higher, it teleports. And the reason they are terrified is that they know the one thing that the mainstream media isn't telling you. The supply simply isn't there. Let's talk about why this is happening now in December 2025. It's not just because the Federal Reserve cut rates, although that poured fuel on the fire. It's because of a fundamental miscalculation in the green energy transition. For the last 5 years, the world has consumed more silver than it has produced. We are talking about a cumulative deficit of nearly 700 million ounces. That buffer stock is gone. It has been eaten by the solar industry. And here's the kicker that Wall Street missed. The technology changed. The solar industry shifted from PERC cells to TOPCon and HJT cells. You don't need to be an engineer to understand what that means. It means every new solar panel requires 20 to 50% more silver than the old ones. This demand is inelastic. That is the most important word you will hear today. Inelastic. If the price of silver goes to $100, a solar panel manufacturer cannot stop buying it. They can't substitute it. Silver is the most conductive metal on the periodic table. If they use copper, they lose efficiency. If they lose efficiency, they go out of business, so they will pay any price. They are the whales now. It's not the Hunt brothers trying to corner the market for greed. It is global industry trying to secure the market for survival. This is a distributed squeeze. It is millions of ounces being absorbed by millions of solar panels, EVs, and AI data centers, never to return to the market. And that brings us to the historical parallel everyone is getting wrong. You're going to hear the financial news channels compare this to 1980. They will bring up the Hunt brothers. They will tell you it's a bubble that will pop just like it did 45 years ago. Do not listen to them. In 1980, the Hunt brothers used leverage, borrowed money, to buy silver. When the regulators changed the margin rules, the Hunts went bankrupt and the selling began. But today, who are the buyers? The buyers are industrial giants paying cash for delivery. The buyers are retail stackers who hold physical metal in their own safes. There is no margin call for a bar of silver you buried in your backyard. There is no margin call for a solar panel installed on a roof in Arizona. This metal is being taken off the table permanently. Furthermore, let's talk about price. In 1980, silver hit $50. If you adjust that for inflation, using the real inflation numbers, not the government watered down CPI, that $50 peak is equivalent nearly $200 in today US money. At $69, we are not at a top. We are barely leaving the basement. We are just now waking up from a 40-year coma of price suppression. The technical chart has completed a massive 45-year cup and handle formation. This is a structure that technicians spend their whole careers looking for. It suggests that the move we just saw, this gap up to $69, is just the opening act. The real target isn't $70, it's triple digits. But the most powerful force right now isn't the charts, and it isn't even the solar panels. It is the psychological shift in the retail investor. We are seeing the rise of Silver Squeeze 2.0. This isn't a coordinated attack, it's a collective realization. People are realizing that if you don't hold it, you don't own it. The trust in the paper derivatives market has evaporated. The inflows into silver ETFs are finally turning into physical withdrawals. The just-in-time inventory system that allowed bullion banks to juggle paper contracts has failed. They got caught short. And now the fear of missing out is kicking in. But this isn't FOMO for a digital token or a meme stock. This is FOMO for a strategic element that is disappearing from the Earth's crust. Mining supply is flat. It has been flat for a decade. You cannot just flip a switch and open a new silver mine. It takes 10 to 15 years. And right now, geopolitical tensions mean that major producers like China are restricting exports to keep the metal for themselves. We are looking at a perfect storm: falling mine supply, exploding industrial demand, and a financial system that is fundamentally short the physical asset. To truly grasp why this squeeze is different, we have to look deeper into the plumbing of the market, specifically at a phenomenon called backwardation. In a normal, healthy market, the future price of silver is higher than the spot price. This is called contango. And it makes sense because if you buy silver for delivery next year, you have to pay for storage and insurance. But right now, we are seeing the opposite. We are seeing backwardation. The spot price, the price to get metal right now, is trading nearly $3 higher than the futures price. This is the market screaming at us. It is saying that traders do not trust that the metal will be there in 3 months. They are willing to pay a massive premium to have the metal in their hand today, rather than a promise of metal tomorrow. This destroys the ability of the banks to manipulate the price. In the past, if the price ran up, they would sell futures contracts to cool it down. But in backwardation, selling futures doesn't work because nobody wants the paper. They want the bar. And where is that bar going? It is disappearing into the black hole of the AI revolution. We talk a lot about solar, but the artificial intelligence boom is the dark horse of silver demand. You see, AI data centers run much hotter and faster than traditional servers. They cannot use standard copper connections because the resistance is too high and the heat generation is too dangerous. They have to use silver. Silver is the best thermal and electrical conductor on Earth. As the world builds out the infrastructure for AI, from the chips themselves to the massive power connectors in the data centers, they are consuming silver in quantities that were not in any analyst's model 5 years ago. This demand is completely insensitive to price. If you are building a billion-dollar data center, you do not care if silver is $30 or $300. You need the conductivity. You pay the price. This is what we mean by inelastic demand. Now, look at the supply side again, because the situation is even more precarious than the charts suggest. Most people think that when the price of silver rises, miners will just dig more, but they can't. Nearly 80% of the world's silver comes as a byproduct of mining other metals like lead, zinc, and copper. That means the silver output is tied to the demand for zinc or copper, not silver. If the economy slows down and copper demand drops, silver production drops with it, even if silver prices are skyrocketing. We are in a supply trap. On top of that, look at Mexico, the world's largest silver producer. The regulatory environment there has become incredibly hostile to mining. New concessions have been frozen. Royalties are increasing. The geological grades are falling. We are having to move tons more rock just to get the same ounce of silver. The era of easy, cheap silver is geologically over. This brings us to the vaults. For years, we tracked the inventory at the COMEX in New York and the LBMA in London. We watched the numbers tick down month after month. We warned that eventually they would hit a functional bottom. That bottom is what we hit this week. When you strip away the ETF silver and the private client silver that isn't for sale, the registered category, the silver actually available for delivery, is dangerously low. This is why we're seeing those cargo planes flying from New York to London. It's a shell game. They're moving the same bars back and forth to try and plug the holes in the dike, but the holes are getting bigger. The gap up to $69 is the market realizing that the emperor has no clothes. So what does this mean for you, the individual investor? It means we are entering a period of the greatest wealth transfer in history. We are moving from a world of financial assets, stocks, bonds, currencies, to a world of real assets. Mike Maloney has talked about this for years. The ratio of gold to silver is compressing, but silver is the race car. When it moves fast. In the 1970s bull market, silver didn't just double, it went up over 30 times. If we are truly in the second great secular bull market, $69 is not the ceiling, it is the floor. The technical analysis, that massive 45-year cup and handle, projects targets well over $100, and potentially much higher if the dollar loses its status as the reserve currency. And that is the final piece of the puzzle, the geopolitical shift. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively accumulating gold, but silver drafts behind gold. As the East moves away from the dollar, they are moving toward physical commodities. China is encouraging its citizens to buy silver. India has imported massive amounts of silver this year, draining the Western vaults. This is a global run on the bank, but the bank is the Western futures market. And the currency they are withdrawing is physical silver. You have to be prepared for what comes next. It will not be a straight line. The volatility will be stomach churning. There will be days where the price drops $5 in an hour as the powers that be try to flush out the leverage. They will try to scare you. They will try to make you think the squeeze is over. But remember the fundamentals. Remember the lease rates. Remember the solar panels that need to be built. Remember the empty vaults. Paper can be printed to infinity. Silver cannot. The physics of the market are undeniable. If you're sitting on the sidelines waiting for a pullback to $20, you may be waiting forever. The train has left the station. The gap up has signaled a regime change. We are no longer in a market defined by paper speculation. We are in a market defined by physical scarcity. This is a battle between the old system of infinite paper and the new reality of finite resources. And for the first time in 45 years, reality is winning. Hold your position. Do not let the noise shake you out. This is a once-in-a-generation event. The shortage is real. The demand is real. And the price is finally starting to reflect the truth. Stay disciplined, stay stacked, and watch the gap, because we are just getting started.